While the panel's in transition, I'm going to make the introductions of the credits of the individuals who are going to be before us. They have quite a number of accomplishments, and I think that by the time they're seated, I'll still be reading those accomplishments. Mr. Daniel Berenbaum is the Chief Program Officer of the National Community Reinvestment Coalition. It's an association of 600 community-based organizations that promote access to basic banking services, including credit and savings, to create and sustain affordable housing and job development. Mr. Berenbaum is responsible for coordinating NCRC's fair housing and fair lending compliance initiatives, and he also manages NCRC's housing counseling network, which, with its affiliates, is HUD-certified housing counseling intermediary participating in the Neighborhood Works Foreclosure Mitigation Counseling Program. Ms. Julia Gordon is Senior Policy Counsel at the Center for Responsible Lending. It's a non-for-profit, nonpartisan research and policy organization dedicated to protecting home ownership and family wealth by working to eliminate abusive financial practices. She specializes in legislative and regulatory policy issues relating to consumer lending, particularly in the area of mortgage lending. Mr. Ronald Ferris is the President of Ocwen Financial Corporation and Ocwen Loan Servicing, LLC, served as Director of Ocwen since May 2003 and as President since 2001. Prior to serving as President of Ocwen, he has held numerous executive positions there and served as Controller for a subsidiary of Ocwen. He's also served as General Audit Department of, in the General Audit Department of PricewaterhouseCoopers, LLP. Finally, Mr. Ed Pinto served as Executive Vice President and Chief Credit Officer for Fannie Mae in the late 1980s. Since then, he has worked as a consultant to the financial services industry, focusing on credit policy, marketing, and product development. He's published research, commentary, and views which are regularly cited by numerous major newspapers, magazines, and think tanks. I would ask the witnesses stand. It's the policy of our Committee on Oversight and Government Reform to swear in all witnesses before they testify. I'd ask that you raise your right hand. Do you solemnly swear to tell the truth, the whole truth, and nothing but the truth? Thank you. Let the record reflect that each of the witnesses has answered in the affirmative. I ask that each of the witnesses give a brief summary of your testimony. Please keep this summary under 5 minutes in duration. I want you to know that your complete written statement will be included in the hearing record. Mr. Berenbaum, you're a first witness. Please proceed. Thank you.
Thank you. Good afternoon, Chairman Kucinich, Ranking Member Jordan, and other distinguished members of this committee. We are honored to testify today before you regarding mortgage reform, mortgage foreclosure prevention, and the activities currently underway to suggest improvement in this area. Solving the foreclosure crisis is critical for the economic health of this country. Since the onset of this crisis, $7 trillion household dollars wealth has been lost. This loss of household wealth translates into reduced consumer spending, depressed business activity, lower gross national product, lower property tax receipts, and higher local and state budget deficits. Foreclosures not only impact individual homeowners, but entire neighborhoods through declining property values, increases in abandonment, decay, crime, and vandalism. In short, the continued failure to adequately address this crisis multiplies the profound social, cultural, and economic injury to our nation. The foreclosure tsunami has been further compounded by the highest unemployment rates in the last quarter century. In a vicious cycle, the record rates of unemployment and reduction in wages are now feeding continued foreclosures. In the face of this great recession, the Bush administration encouraged the private sector to create the Hope Now Alliance. The Hope Now Alliance recorded 3.1 million loan workouts during 2007 and 2008. But two-thirds of these workouts deferred or rescheduled borrower payments without lowering monthly payments. Meanwhile, the foreclosure crisis worsened. Subsequently, the Obama administration created two programs, the Home Affordable Modification Program and the Home Affordable Refinance Program. Unfortunately, as has been noted already, both by the chairman and the minority member, these programs are not keeping pace with the foreclosures that we are seeing today. Our written testimony discusses in detail the origins of the crisis, problematic non-prime and non-traditional lending, compounded by regulatory failure, greed and malfeasance, little or no fair lending or consumer protection oversight, and serious safety and soundness lapses. An analysis of the public information that is available documenting the performance of each of the programs is in our written statement. The experiences of our housing counseling network, qualified housing counselors around the nation, as well as the testimony of Mrs. Patricia Stringfield, document the importance of HUD counselors in this process. However, the magnitude of the foreclosure and unemployment crisis calls for more proactive intervention, and that means a private partnership between both government officials as well as servicers, investors, securitizers, and others. Despite the best of intentions, we are not seeing results in these programs because of their voluntary nature, and a more considered mandatory approach should be taken. Yesterday, the Mortgage Bankers Association announced a voluntary unemployment borrower bridge to HAMP modification programs. That will help a limited number of borrowers who experience temporary unemployment for a period of up to 9 months. It certainly will not address the pre-existing problematic underwriting that occurred, overvaluation, or serve as a substitute for permanent principal reduction or other programs such as NCRC's Help Now model that we have suggested in our testimony. The Help Now model originated in discussions with Wall Street. It uses Wall Street's own reverse auction process to, in fact, promote the sale of large groups of large groups of mortgages, mortgage-backed securities to Treasury or another agency. It could also be, for example, other departments. It could be HUD, but using the current market value of the homes and then passing those savings on to the homeowners so they have principal reduction, and in turn selling those loans back as 30-year, 40-year fixed-rate loans to the private sector at little or no cost to the taxpayer. Authority for this program exists under the current TARP program. It exists under eminent domain, and frankly, it could be done with modest changes to the tax requirements if, in fact, Congress chose to act in that direction. As well, we want to see loan programs established for the unemployed, such as H.R. 4173 passed by the House, as well as more broad interpretation for principal reductions within the HAMP program. Substantial research documents that the most successful loans, the loans that are not falling out of permanent modifications, are in fact loans that have had principal reduction. Last week, the administration announced a $1.5 billion initiative to target 5 states. We agree with this committee that, in fact, a much more broad need is necessary. There is no reason to focus on volume or size of loans over the quantity of modifications that are currently needed across our nation. In closing, let me say that we also suggest other improvements for HAMP. Those improvements include greater transparency and reporting of data. It includes also expanding areas of the law in judicial modification, as well as expanding and modernizing the Community Reinvestment Act. Thank you.
I thank you, Mr. Berenbaum, for your testimony. Ms. Gordon, you're recognized for 5 minutes. Thank you.
Good afternoon, Chairman Kucinich, Ranking Member Jordan, and members of the committee. Thank you so much for inviting me today to talk about the government's response to the foreclosure crisis. We need a much more robust and effective plan to save homes and prevent unnecessary foreclosures. Over 6 million homeowners are now behind on their mortgages and at risk of foreclosure. More than 2 million foreclosures have occurred in the past 2 years alone. By 2014, researchers predict that up to 13 million foreclosures may have taken place. This crisis has been particularly hard on African American and Latino communities, widening the already sizable wealth gap between whites and minorities and wiping out entire formerly middle-class neighborhoods. The spillover costs are massive, including lost property values, even for homes current on their mortgages, erosion of the tax base, and the increased burden on municipal services. Before I talk about the details of foreclosure prevention, I want to refer to the many people who will try to convince you that this crisis was caused by public policies aimed at expanding the American dream of homeownership to all communities. This claim is nothing short of outrageous and insulting. Every single bank regulatory agency has pronounced this allegation false, and there is no good data to back it up. This foreclosure crisis was caused by toxic loan products that were sold to people for profit purposes and that preyed particularly on the communities that I've mentioned above. Most borrowers could have qualified for cheaper mortgages with less risky terms, and the vast majority of these loans weren't even sold to first-time home buyers. These products were designed to become affordable within a couple of years so that mortgage brokers could refinance the same customers over and over again, like Ms. Stringfield, and receive a fee each time. Wall Street's appetite for risky loans was seemingly insatiable, and lenders scrambled to deliver more loans to keep the money coming. It's also not true that unemployment right now is the culprit rather than bad lending. Risky loans are approximately 3 times more likely to default, no matter what the underlying economic conditions or where you live. In fact, during every other period of high unemployment in recent decades, foreclosure rates remained essentially flat because people had a home equity that could cushion the blow. In responding to this crisis, the government so far has given the most help to the people who need it the least. Programs to lower mortgage interest rates and the home buyer tax credits have helped support the housing market in the face of historic levels of default, but haven't helped the people at highest risk of losing their homes. As we've discussed already, the centerpiece of the administration's foreclosure prevention effort, the Home Affordable Modification Program, has not reached its potential. A key obstacle impeding HAMP's success is that the private servicing industry has been either unable or unwilling to do the job they need to do. Originally, the HAMP program was meant to be coupled with other legislative changes that would have backstopped the program and provided other incentives for servicers to perform, but those legislative changes did not occur. As a result, HAMP is essentially a voluntary program where homeowners themselves still have no power or control over their situation. Participating servicers routinely violate the program's guidelines and fail to convert performing trial modifications into permanent ones in a timely way. Homeowners are given very little information about how their loan modification request was evaluated, and they have no independent appeals process if they believe their request was denied unfairly. In our written testimony, we've laid out a number of detailed suggestions for improving HAMP. What I want to focus on here is the importance of requiring servicers to reduce the principal balances for underwater homeowners. Being underwater is the most accurate predictor of default or redefault, and until mortgages are right-sized on a routine basis, it is unlikely we will see the end to this cycle of redefault. We also need action outside of HAMP to make HAMP work. A law requiring that servicers evaluate all homeowners for loan modification prior to initiating foreclosure could give homeowners the right to fight their foreclosure if such an evaluation were not conducted. It's also crucial to permit judicial modifications of mortgages on primary residences. This solution costs nothing to the U.S. taxpayer. It's the only solution that cuts through the Gordian knot of second liens, securitizations, negative equity, and back-end consumer debt. Finally, we need common sense rules that prohibit lenders from making loans that borrowers can't afford, and we need an independent consumer financial protection agency. If there's nothing else that we've learned from this crisis, it's that it's much easier and far less expensive to prevent problems than to clean up after them. Thank you so much for inviting me today, and I look forward to your questions.
Thank you for your testimony. Chair recognizes Mr. Ferris. You may proceed.
Thank you, Chairman Kucinich, Ranking Member Jordan, and distinguished members of the subcommittee for the opportunity to participate in today's hearing. My name is Ronald Ferris, and I am the President of Ocwen Financial Corporation. At Ocwen, we share your sense of urgency to find a lasting solution to our nation's daunting foreclosure crisis, a crisis that threatens millions of families with the loss of their home. Ocwen is not a loan originator. We did not make the bad mortgages that are causing the problems. But as a loan servicer, we are doing everything we can to fix them. We were the first in the industry to adopt a comprehensive loan modification program, one that provides homeowners in distress lower mortgage payments that are both affordable and sustainable and result in greater cash flow for investors than from foreclosure. We are proud to have saved well over 100,000 homes from foreclosure since the onset of the mortgage crisis through loan modifications. Ocwen supports the administration's HAMP program. We believe it is a well-designed response to the mortgage crisis. Even so, almost a year into HAMP, too many homeowners facing foreclosure are having difficulty getting their loans modified. In our view, this is due mainly to a lack of sufficient capacity and expertise in the industry to handle the volume. Ocwen has invested over $100 million in R&D to build our own loan servicing technology. Our platform is both scalable for high volumes and incorporates behavioral science research for effective customer communication. Using technology, we have been able to convert trial modifications to permanent modifications at a rate that is 10 to 20 times higher than the big banks in the program. But the key metric for long-term success is the redefault rate. According to a recent industry report, 3-month redefault rates on HAMP mods have ranged from 18 to 33%. Through our technology advantage, we have kept our redefault rates to below 5%. As part of Ocwen's continuing commitment to make HAMP a success, we would like to share with the subcommittee some of our recommendations for program enhancements. First, the required debt-to-income ratio should be lowered to below 31%. 1 out of every 4 HAMP applications is rejected for failing to meet this standard. Usually these are families struggling with higher household expenses for food, clothing, and education. HAMP should instead use a flexible residual income approach to determine a payment that the homeowner can actually afford. Alternatively, there should be either an across-the-board DTI of 28% or a sliding scale DTI that varies based on the number of dependents on the borrower's tax return. Second, principal reduction modifications are needed to overcome the negative equity problem. This is a primary driver of defaults on mortgages, and redefaults on modified mortgages. 11.3 million mortgages in this country, or 24%, are currently underwater, and these numbers will likely grow. In Ocwen's experience, negative equity increases the chance of a redefault by 1.5 to 2 times. Accordingly, approximately 15% of all of our loan modifications have involved some element of principal reduction. HAMP already addresses principal forbearance, but there is no provision for principal forgiveness. We believe step principal forgiveness is best. That is, incremental principal reductions over time, so long as the loan remains current. Third, additional funding should be made available for housing counseling groups. Grassroots organizations like NCRC, who is here today, ESOP in Ohio, Home Free USA, National Council of La Raza, and so many others around the country are providing much-needed homeowner outreach and counseling. We urge financial support for any HUD-certified counseling organization assisting homeowners through a successful permanent modification under HAMP. Fourth and last, underperforming HAMP servicers should be required to outsource to performing servicers. Whether for lack of effort or just an inability to handle the volume, too many banks are not producing the results needed to achieve program goals. Treasury should be empowered to redirect servicing to those with a proven track record and available capacity to execute trial modifications and convert them to permanent solutions. Let me conclude by thanking you again for inviting me to testify today and asking that my full written statement be entered into the record. Thank you.
And it is so ordered. And thank you, Mr. Pinto. You may proceed for 5 minutes. Thank you.
Chairman Kucinich and Ranking Member Jordan, thank you for the opportunity to testify today. Let me first provide some background regarding the cause of the foreclosure crisis. Chart 1 demonstrates the loan-to-value ratios and foreclosure rates that have been increasing in this country for decades. You'll see that FHA has been leading the way for decades also in rising loan-to-values. FHA's foreclosure start rate now stands at 32 times the level that it had in 1951. The collapse of the mortgage market had a single cause: the accumulation of an unprecedented number of weak loans. In 2008, approximately 50% of
I'm going to ask the gentleman to suspend. We got to make sure we can hear you. You need the mic.
Okay, sorry.
And speak into it. Thank you. Thank you, staff.
Thank you. The collapse of the mortgage market had a single cause: the accumulation of an unprecedented number of weak mortgages. In 2008, approximately 50% of outstanding single-family mortgages were weak and prone to failure, with 2/3 being the result of federal programs. How did this happen? In 1995, the federal government issued its National Homeownership Strategy. It required the use of flexible and alternative lending in, quote, an unprecedented public-private partnership to increase homeownership to record high levels over the next 6 years. With this national policy in place, the lending equivalent of Gresham's Law took place. Weak lending drove out good. Turning to the administration's Home Affordable Modification Program, I'd like to recall HAMP's original goal that still is posted on their website: to help as many as 3 to 4 million financially struggling homeowners avoid foreclosure by modifying loans to a level that is affordable for borrowers now and sustainable over a long term. The Treasury Department has consistently painted rosy scenarios regarding HAMP's progress. In an apparent desire to post big numbers early on, the concept of a trial modification was introduced. Borrowers were allowed to enter a trial without qualifying on the basis of income. This wasn't fair to borrowers who had no chance of qualifying. Many will be worse off than if they'd been given a quick no and encouraged to find alternative housing. As a result, the HAMP pipeline became hopelessly clogged, with the lion's share of the blame, in my opinion, falling on Treasury. The January 2010 HAMP report contains a statement that strains credulity. It noted, quote, the program is on pace to meet its overall program goal of providing 3 to 4 million homeowners the opportunity to stay in their homes, close quote. That was not the goal. The truth is HAMP has been a spectacular failure when measured against that goal. In the first 11 months, there have been 116,000 homeowners who have received permanent modification. Subtract expected redefaults, and you might end up with 75,000 homeowners who are saved from foreclosure, about 2% of the goal. I predict that ultimately HAMP will only meet a small percentage of its 3 to 4 million foreclosure goal. The same redefinition of program goals applies to HARP, Treasury's refinance program. It was to help 4 to 5 million homeowners shut out from refinancing because their current loan-to-value is above 80%. Through December 2009, Fannie and Freddie have completed 190,000 HARP refinances, less than 5% of their goal. Not a problem. Making Home Affordable 2010 January 2010 report now takes credit for 4 million refinances of all type, regardless of LTV. Treasury promised transparency. What we get are disingenuous progress reports when it comes to program goals. This committee and the American people deserve an honest assessment of what HAMP and HARP can do. Why is the problem so intractable? We're facing a more challenging situation than ever because credit standards were severely compromised by federal policies prior to the onset of the current crisis. What delinquent borrowers in the housing market needs is triage that provides quick answers and fast decisions. This will allow the shadow inventory of millions of defaulted loans that cannot benefit from a modification to end up in the hands of qualified homeowners. Late last month, Treasury announced changes to HAMP process which should help meet the goal of providing quick answers and fast decisions. It will hopefully put an end to no-doc trial modifications. Unfortunately, the changes do not take effect for 3 more months. One last note, in Ms. Caldwell's testimony, it's noted that $2 billion in savings have already been recognized by HAMP participants, and administrative action has kept interest rates at historic lows. But I think we must be honest. There is no free lunch. Tens of millions of Americans, many pensioners, living on their savings, many of your constituents, are suffering a real loss of income due to these low rates. Households in this country own $11 trillion in fixed assets. Many are now earning about 2% less than previously. That's over $100 to $200 billion a year in lost income and tens of billions of dollars in lost taxes. Thank you, and look forward to your questions.
Thank you, Mr. Pinto. There's no such thing as a free lunch, but apparently there's multi-billion dollars in bonuses for bankers who got TARP, so we'll have to figure out how that squares with folk wisdom. I heard Ms. Gordon correctly talk about the root of the crisis. And I think we should be clear that this foreclosure crisis started well before the current administration came into office, and it is rooted in policy decisions that created the largest asset bubble in American history, an $8 trillion home mortgage bubble. So to call this crisis a subprime crisis would miss the point. The bubble was created by Federal Reserve policies that kept interest rates low for for the explicit purpose of allowing home prices to inflate, knowing and expecting and tacitly encouraging that homeowners would use their rising home values to supplement stagnant wage incomes. Using a house as an ATM wasn't a product of greedy and irresponsible homeowners. It was a product of a shrewd but ultimately disastrous government calculation and policy. And American workers have been the biggest losers in this crisis so far. They're the ones who have been thrown out of the workplace in large numbers, had their hours reduced, their benefits cut. They're the ones who have been forced to give up their family homes, endure bankruptcy, and the ignominy of public foreclosure proceedings. So labeling this crisis subprime crisis would really be blaming the victims. The crisis was not caused by people who lost their homes and their life savings, their jobs, and their reputation. It was caused by people who perpetrated what I think is a kind of a hoax. Responsibility for the crisis and repairing the damage falls on every person and every institution, including past and current representatives of both members of Congress, or both parties in Congress, rather, as well as the last administration, and this current administration now has the responsibility, who should have been and are responsible for assuring the ethical and financial integrity of our banking and monetary system. We're picking up the pieces here. Now, Mr. Birnbaum, you mentioned in your testimony the role of credit rating agencies in influencing loan servicer behavior, making them to be more inclined to act on a delinquent loan first by foreclosing on it, then modifying it, and only as a last resort cutting principal. Can you elaborate how credit rating agencies influence this process?
Certainly, Mr. Chairman. There's unfortunately more and more growing evidence now that the SEC failed to appropriately regulate or monitor the credit rating agencies in this nation. And the way the system worked, in fact, it worked toward incentivization of profit and simply affirming whatever paper was presented before those rating agencies. They actually even called themselves publishers of information rather than, in fact, reviewers of that information. This also led to significant fair lending issues because if you look at, in fact, many of the AAA ratings that those agencies gave, subprime, non-traditional, it was to companies such as Ameriquest, New Century, and others, which has impacted not only on Ohio, but frankly, low to moderate income communities across the country.
Thank you, Mr. Birnbaum. One final question, Ms. Gordon. Are there legal solutions to the obstacles that some might see in doing principal reduction for borrowers?
I'm not sure what you mean by legal solutions, but one of the obstacles right now is that a number of these loans held by investors have second liens on them. About half of all securitized loans have a second lien.
So does Treasury have leverage to get around that?
Well, you know, Treasury has a program. Treasury unveiled a program in spring of last year, the 2MP program, designed to try to attack the second lien program, but no servicers have used it. I had heard that Bank of America has now signed up for it. I don't exactly know what that means, but as far as I know, no one has yet used the 2MP program in the HAMP program. It seems to us that Treasury should require servicers to use the 2MP program to resolve these second liens, which are essentially worthless at this point in most cases.
Thank you. Mr. Jordan.
Thank you, Mr. Chairman. Ms. Gordon, do you believe that HAMP is working at all? Do you think it's a pretty bad program? I mean, you think like I do. You think the track record of HAMP is
it's clearly underperforming what we need to do to get ahead of this crisis.
Okay, so here's where I'm a little confused, because in your testimony you said federal policies had nothing to do with contributing to the mess that we got in. You said the government had nothing to do with contributing to the mess we got in, even though the track record of government trying to fix it is pathetic. I mean, I mean,
The federal
so
policies I'm referring to in that section are, there's been a lot of talk about how the Community Reinvestment Act and other policies, in fact, I think Mr. Pinto mentioned this earlier, are somehow responsible for the toxic loan products, when in fact, for the most part, the loans made under CRA were safer loans and ended up having a much better performance profile than the risky loans that were made outside of that system.
Mr. Pinto, is that an accurate statement, the loans, the one that Ms. Gordon just made relative to the Community Reinvestment Act?
The accurate part of the statement is most Community Reinvestment Act loans were fixed rate, lower interest rate loans. If you compare those loans to other fixed rate loans that had higher interest rates, my research shows that the default rates on the CRA loans are also high. I give you one example, ESOP with Third Federal Savings, and ESOP has testified a number of times about the great job that Third Federal had done. What they haven't testified about is the performance of those loans. These were CRA loans, low interest rates, they were subsidized generally. They're running a 37% delinquency rate on a $300 million portfolio. Third Federal has suspended the program and because of its poor performance.
Do you agree with my statement that I made in my question to Ms. Gordon that federal policies, I know you agree with this, federal policies help get us in this mess. How in the world are federal programs going to help get us out of it? I mean, I come from this whole thing. If big government spending, big government programs are going to get us out of this economic concern we've been in, well, heck, we'd have been out of it a long time ago because that's all we've been doing for 2 years. I mean, we have seen things we never imagined we would see in the United States of America. So I just don't, and we can't even get now Treasury just to comply with, I mean, if you were here for my earlier question, Ms. Caldwell, we can't even get them to comply with what the Inspector General wants them to do on the original no-doc loan, getting documentation. I mean, it just highlights and underscores when you travel down this road, you end up making things worse, and when you attempt to solve it, what you do is put a lot of taxpayer money at risk and not really help the people who, I agree with my colleague, who has passion. I mean, we all do. You don't really help the folks who, frankly, need some help. So comment on that, then I'll get back.
Let me just comment that in the first quarter of 2009, the OCC OTS puts out their mortgage metrics report, and there were 190,000 modifications that were done in that quarter. There were about 150,000 that were done in the second quarter. This is before HAMP got ramped up. And there was a growing tide of those, heavily growing tide into interest rate reduction, much like HAMP. Since then, the number of modifications reported has declined, and I believe we're going to end up seeing that the $190,000 loan number that existed in the first quarter won't be surpassed in 2009. So it's actually slowed down the process. And I think my suggestion is focus on Fannie and Freddie, which I think are 60% of HAMP, and let the private sector on their loans deal with them the way they were actually doing many things back in early 09.
Homeowners would be better off financially. They get some quicker remedy, whatever, or, quicker action, whatever that would be, and we could focus on where the bigger problem is, Fannie and Freddie.
Right.
Great point. Great point.
I thank the gentleman. Chair recognizes Ms. Capter.
Thank you, Mr. Chairman. This has been an outstanding panel, and I thank you very much for coming today and what you've placed on the record. Several witnesses today, including many of you, recommended principal write-downs. Let me offer the observation that I don't think servicers can do principal write-downs. Many servicers have business with the 5 biggest banks that caused this mess to begin with, coupled with the changes in the banking laws back through the 90s that changed prudent lending to securitization, and local banks holding a portion of those loans, and we moved it to a bond. We changed a loan to a bond, and they sold it to everybody on the face of the earth. And so the collectability issue, Mr. Pinto, you used 3 words, collateral, credit, and capacity. I always say character, collateral, and collectability. There's no collectability. And so how do you do the loan workout? How do you do the normal accounting changes? That's where I want to go. by using FDIC, SEC, and those involved in that given loan. I don't think we can get it through the servicers. I think HAMP is proving that. We can't do it. So we need to be able to do what we did back in the 80s. We need to be able to work out those loans, get the assets and liabilities to balance on those books, and there's going to have to be some real estate write-downs. We're going to have to get down to some level within the banking system, and that is what is not happening. And I wanted you to comment on that. I wanted you to comment on two things for me. One is your view of servicers being able to solve this problem through HAMP, even as you ask for principal write-downs. And if you were to recommend to the President how to rearrange what he's doing in order to get at this real estate crisis so we don't have millions of homes vacant across this country, how would you tell him to, who would you tell him to bring into his office, the Oval Office, all these agencies so we can get at the value of real estate and do loan workouts where we can get them done? So I want you to comment on the principal write-down, who can actually do it, I don't believe the servicers can. And then what would you say to the President to get to where you want to go and help us to move the housing market to a more positive position and keep people in their homes?
Ms. Kapner, if I may jump in, I think that's an excellent question, and I'll respond quickly to allow each of the panelists their opportunity. Right now, there's an over-reliance in balloon payments by servicers across this country, so really there is no principal reduction. Frankly, what we are hearing from the investor community is that they are ready to begin some serious principal reductions, and to paraphrase, they are ready to take their share of the haircut that's necessary to correct the marketplace. But the system right now is loaded with conflicts. For example, you noted earlier that a majority of the seconds are held by the banks, the same banks that operate the majority of the servicers in this nation. Conflict number one. Conflict number two is some of the accounting rules that we've been discussing in this presentation and before this hearing as well. Issue number three, we have to get beyond the blame game. Everyone is at fault. There is shared blame here. And if we are going to move ahead, we need to ensure a meaningful regulatory restructure that embraces the Community Reinvestment Act for what it has done in responsible lending for community reinvestment. We need to embrace a strong Consumer Financial Protection Agency, and we need to work with responsible servicers and lenders who are willing to do business in the way that is required to bring trust back to the market that you spoke to earlier. We are not going to see global investors or pension funds or others buy in the secondary market until those minimum requirements are made. Last, one more point that I'd like to make is that we do need to focus on the HARP program as well. Ultimately, who owns that $400 billion of risk right now? It is not the private sector, it is the taxpayers. What a wonderful way to go about, in fact, reaching 70% of the outstanding mortgages by, in fact, reducing the risk associated to the taxpayer through principal reduction. We have the power to do that through eminent domain or through the power of Congress.
Thank you. Ms. Gordon, did you want to say something there?
Well, I agree with most of what Mr. Birnbaum has said. I will note that servicers in serving accounts that are held in portfolio seem quite able to do principal reductions. There are principal reductions happening. They're just not happening for the securitized loans.
And what percent are represented of the portfolio of securitized loans?
Well, that depends on the servicer. So, but in terms of the troubled loans, quite a lot of them are securitized. The places where the portfolio loans are doing the most principal reductions is with respect to payment option arms, which for the most part are so underwater, not only because they're located in some of these highest price decline states, but also because they had negative amortization built into the loan. These loans are very poorly served by HAMP. HAMP can't really help them for a variety of structural reasons. So it's clear that the problem does have to do with these conflicts of interest, and I completely agree with you that not all of the banking and securities regulators that need to be at the table seem to be at the table rowing in the same direction with the Treasury's program. I know the folks at Treasury, despite my concerns about the underperformance of the program, I know that they're trying their best, but there needs to be a team approach here, and we already know that the prudential regulators have not had a history of putting consumer interests at the top of their agenda. You know, that's why it's so important to have an independent consumer protection agency. But most of all, this is why it's so important to do things like change the bankruptcy code. I mean, ultimately, you need someone to just, who has the power to cut through all of this, regardless of the various interests and conflicts involved. We already have a system set up in this country for that. The entire bankruptcy system does just this. Principal residence mortgages are the only type of debt that can't be restructured. Your second home mortgage can be, your yacht can be, but not the home that you live in and have made your life in.
Thank you very much for your testimony. I want to thank all the witnesses. This is the Domestic Policy Subcommittee, joined by my colleague, Congresswoman Capter, and we've had a full hearing today with many members of Congress testifying or rather participating. I'm Congressman Dennis Kucinich, Chair of Domestic Policy. We are going to continue our work on this issue, and we are going to continue to work for a serious program of principal reduction in order to help keep people in their homes. Thank you very much. Adjourned.
Turn when he gives into his most shocking cravings.
I want that guinea pig out there. I've eaten iguana, actually. It was the worst tamale I've ever had in my life.
Anthony Bourdain, No Reservations, Ecuador, returning Monday at 10, only on the Travel Channel.
Let's recap the beaches we've been to so far. In at number 10 is the action-packed Hyatt Regency Aruba Resort and Casino. Our number 9 pick, Keneal Bay St. John, is a dream come true for romantics. At number 8, it's a pirate's life for those seeking privacy at the Parrot Key Resort and Spa on Parrot Key Island. In at number 7 is the tropical wilderness of Little Dix Bay, Virgin Gorda. Our number 6 selection, the all-inclusive Beaches, Turks, and Caicos Resort and Spa, left nothing out. We're putting on the Ritz at our number 5 resort, the Ritzy Ritz-Carlton St. Thomas. Number 4 is Four Kinds of Wonderful for golfers, the Four Seasons Resort, Nevis. Number 3 is where families discover Atlantis on Paradise Island. And our number 2 selection is second to none for spa. It's the Sandy Lane Resort, Barbados.